What's up everybody, Nate here, and if you haven't noticed by now, the stock market is having a little bit of a problem recently. Actually, it's kind of a big problem because the stock market is essentially melting. Ever since the start of 2021, the stock market has essentially went down. And even just a few weeks ago, the Dow, S&P 500, and NASDAQ were nearing a correction territory, which is around a 10% drop for each. Flash forward a couple weeks though, and we're still suffering from the same problems. In fact, the stock market right now is having its worst week since March 2020. And we all remember what happened back in March of 2020. We saw one of the fastest stock market crashes in its history. So is that happening again right now? Well, that is the question of the day, and that is what is on most investors' minds right now. That and when Elon's Cybertruck is coming out. But today I want to talk all about the New York Stock Exchange and why the stock market is tanking right now, and if we are going to see a similar crash like we did back in March of 2020. But before I break all of this down, do me a quick favor and absolutely destroy that thumbs up button below. I appreciate you doing that, and if you haven't yet, it's totally free and it helps me to know that I appreciate you doing that, and if you haven't yet, it's completely free and it helps me to know that you love the content on this channel and you want to see even more. Thank you so much for doing that. Now let's talk all about the stock market. So markets are finally coming down after having a pretty much stellar 2021. We saw the Dow, S&P 500, and NASDAQ index break their all-time record highs last year. And right now we're only at the start of 2022. So what could have possibly changed from 2021 to 2022 that now has investors scared and panic selling all of their assets? Well, it's not really a one thing issue. It's more like a combination of issues that have kind of been building for a long time now, creating the perfect storm for a stock market crash. The first and the biggest reason why the stock market is tanking right now is because of all of the tech stocks. Yes, the tech stocks that have exploded over the last 2 years. They're now tanking pretty much across the board. Now, of course, I will preface this by saying you have some outliers in the tech stock market. One of those is, of course, Apple, who just posted record earnings in January 2022. But as a whole, tech stocks are now tanking after booming over the last 2 years. In fact, in 2021, global tech startups raised around $620 billion. That's almost as much as the last 6 years combined, and it's definitely a single-year record. And part of the reason for that is because of the IPO craze that has been happening on Wall Street for about 2 years as well. An IPO is an initial public offering, so it's basically the first day that a brand new public company is offered to the public on the New York Stock Exchange. A company essentially launches its IPO so that it can get public support from more than just private investors. Typically, there are two types of companies, a public company and a private company, and private companies don't really have a lot of capital to begin with. They have to get money from venture capitalists or private investors. A public company, though, can get money from anybody that has a brokerage account for the New York Stock Exchange. Big public companies are like McDonald's, Apple, Microsoft, Tesla, and of course, GameStop. The benefit to launching an IPO is that you get way more capital, which means you can grow even faster. You now have all of this liquidity because investors are just giving you hundreds of dollars per share. And in 2021 alone, we had 980 new IPOs launch on Wall Street. That is more than double what we saw in 2020. And that's a lot of companies, and there's a lot of interest behind these companies because investors can get in initially early. And the potential to grow is pretty much unlimited. I mean, you're getting in on the ground floor of brand new companies. This is in an emerging market of a tech field that is pretty much unexplored. But the problem with these IPOs that have launched on Wall Street is that there are now billions of dollars behind them, and unfortunately, a lot of them are not making any money. And while that has a lot of potential and even more excitement behind it, that doesn't mean that the company is going to be successful. What we're finding out is that a lot of these companies who launched as an IPO on Wall Street in 2021 are now starting to report their earnings in Q4 2021 and Q1 2022. And most of them are bringing in zero profits. And investors are starting to get worried. They're worried because these companies are not making any money. And if they're not making any money, then they can't be sustainable. This is the risky part of the stock market that investors always talk about. You are never guaranteed to make money when you invest. That's why a lot of investors play the long game and they invest in companies that are super stable and that are going to be around for a very long time. These tech startups, though, we don't know much about them, and they could be around for a very long time and could be the next big thing, but they could also essentially tank. And a lot of them have stock values in the hundreds of dollars. So investors are putting in hundreds of dollars worth of shares into those companies, and a few years from now, those shares could go from $200 all the way down to zero, and the company could go bankrupt. Investors are starting to get worried right now that that is going to happen, and it's reminding them of the dot-com bubble that we saw in 2001. Basically, what was happening there was the internet was emerging. That's right, Gen Z, the internet wasn't always around, and it's really only been around for the last 30 years or so. With the internet being pretty much uncharted territory, the stock market wanted to get in, so companies were launching as IPOs, but they were launching as websites. So they were putting that .com at the end of their name, and they were immediately valued at the hundreds of millions, if not billions of dollars. Investors were pouring money into these fields because they knew the internet was going to be the next big thing, and they were absolutely right, but they weren't right about a lot of these companies. And the same exact thing ended up happening. These companies launched as IPOs, had a lot of promise, but then went bankrupt because they weren't making any money. They were good in concept, but they just weren't good companies. So in 2022, we're left with this tech stock bubble, which is eerily similar to the dot-com bubble of 2001. And for a lot of investors, that bubble is about to pop. So investors are pulling their money out of all those investments, and because of the speed that they're doing it, we are reaching correction territory and new 2-year lows on the stock market. But that is not the only thing that's affecting the stock market right now. With the tech stock bubble essentially exploding on Wall Street, investors are starting to be a little bit more careful with their money. They're starting to move their assets from those risky tech stocks into more stable investments. Part of that is coupled by the second thing that is affecting the New York Stock Exchange right now, the Federal Reserve. Now, the Federal Reserve has been in the news a lot over the past 2 years. From everything from inflation to interest rates to printing money like there is no tomorrow, the Federal Reserve has had a massive impact on our economy since the pandemic basically started. And that impact is now continuing because they've talked a lot recently about raising their benchmark interest rates from 0% all the way up to possibly 1% by the end of this year. Now, here is what that basically means. The Federal Reserve sets its benchmark interest rates to kind of give an indication to banks and other financial institutions about which way our economy is going and how easy it's going to be for people to borrow money. If you have really high interest rates in the 2, 3, and even 4% range, well, then it's really hard for banks and people in general to get money. Think of it this way. If you applied for a $5,000 loan and the bank gave you $5,000 and said, all you need to do is pay that $5,000 back, well, then how exactly does the bank stay in business? They gave you $5,000 and now they ended up with $5,000. And actually, after the lifetime of that loan, they have less than $5,000 because of inflation. So what these institutions do is tack on an interest rate. So if you have really good credit and a really good stream of income, you can get a really good interest rate. The lower, the better, because then you are paying the bank less for using their money. It's basically the fee that you pay for borrowing the bank's money. But the United States government and the Federal Reserve do the exact same thing, except for to banks, financial institutions, and to the American people. The Federal Reserve tells the Treasury Department how much money needs to be printed in the United States every single year. And since the Federal Reserve is kind of a private entity, the United States government and the United States is basically borrowing that money. That money eventually needs to get paid back to the United States via taxes. But back to the whole interest rate thing. So the Federal Reserve wants to raise its benchmark interest rates because interest rates have been so low. In fact, they've been around 0 to 0.25% over the last 2 years. This means that it was super easy for anybody to get a loan, which essentially kept our economy going during the pandemic. We did not know what was going to happen during the pandemic. We didn't know if people were going to be out of work for months or even years because of how things were progressing. So in order for our economy to function, people need to go out and spend money. And if people aren't getting money from their jobs, then they're not spending money. And if people aren't spending money at corporations or businesses, then those businesses and companies aren't making any money either, and they can't pay their employees. So basically, the stream and circulation of money in our economy was grinding to a halt. The Federal Reserve and the United States government wanted to end that, and they decided to print trillions of dollars in stimulus. This trillions of dollars would essentially be trickled down to the American people so they could spend even though they weren't working. That kept our economy going, and it pushed us out of a recession at a faster rate than we have ever seen in American history. That's a good thing, but it also meant that people were spending at a crazy rate, including people on Wall Street. With money so easy to come by, investors were basically buying whatever asset they wanted. I mean, it wasn't their money that they were spending, it was the United States money. So they just continued to spend, and they were investing in all of these risky assets, like tech stocks that were basically unproven and cryptocurrency that is extremely volatile. Now flash forward to today, the Federal Reserve wants to raise its benchmark interest rates again, starting in March of 2022. What that means is that investors can no longer easily trade on margin. So margin trading means that investors are borrowing money from a brokerage or exchange in order to make trades. It's going to be a lot harder to do that when interest rates are going up. You take on a lot more risk. And what that means is the potential to lose money is a lot higher. A lot of investors don't want to lose their money, so they're just not going to make those trades. They're going to invest in really stable assets. And that's the exact reason why we've seen cryptocurrency start to tank too. Cryptocurrency, at least right now, is seen as a risky asset. It's extremely volatile and is still working out a lot of kinks like scams and hacks that traditional investing has already done. So investors don't want to lose their money if all this free money is starting to disappear. They don't want to lose their money. They were okay investing Uncle Sam's dollars, but now that it's down to just their money, they're out. So stimulus is essentially disappearing, which means we have a tightening of money in our society. Investors know that, and they don't want to spend a ton of money right now. So they're starting to pull their money out of the New York Stock Exchange and basically recalibrate. And finally, the third thing that is keeping the New York Stock Exchange down right now and is sending it into a tailwind is inflation. Now, inflation is a big problem for not only the stock market, but the American people in general. In December 2021, inflation hit a 40-year high of around 7%. And pretty much every key inflation gauge that has come out over the past 4 to 5 months has shown that inflation is going up. Now, the Federal Reserve is just now starting to act. And actually, as of January 2022, they haven't really done anything. They've started to pull their money from the New York Stock Exchange. They were buying billions of dollars every month in corporate bonds and mortgage-backed securities and treasury notes on the stock market in order to continue to push it up as well, but that money is starting to disappear too. And they're raising their interest rates, which means demand is ultimately going to go down for money in the United States. But inflation is a bigger problem than just that, because when you have an inflation problem, everything in your society needs to go up. Prices of everyday items need to go up. Prices for services need to go up. Wages also need to increase. Now, companies and people are having to pay more for all of the same things. And if this gets out of control, then you have a period of hyperinflation. Now, we are not facing hyperinflation in the United States, at least not yet. But people spending way too much for the same things is an issue, and it causes consumer confidence to go down. If people aren't willing to go out and spend their money, well, that's bad for businesses, because now all of the issues that we're facing are going to amplify because companies don't have enough money. And two, our supply chain issues are not going to get better if people don't spend any money. When the pandemic first started, supply chains were restricted further than they have been in a long time. Companies basically shut down for several months and nothing was going anywhere. That eventually created a backlog, but with all of the money printing and stimulus throughout our economy, people were buying things at a record rate. They were just buying things because A, they needed to have them, or B, because they wanted them. With that being said, we kind of ran out of just about everything, and now we're facing supply chain issues for everything. Supply chain issues on building materials, supply chain issues for sending those materials out. Every part of our supply chain is constricted right now. And that means we have a low supply of things, but a very high demand, which equals our high inflation rate. Now, eventually that can be fixed because if people continue to buy a lot of things, well, that signals to companies that there's a need for those things. They start to produce more, which means they need to start hiring more people and overall making and producing more things for the American people. But if people stop buying stuff, well, then that's bad for companies because now even though they need to produce more, they just can't. They can't afford to produce more. If they start doing that, then they're going to lose a ton of money and they may have to even shorten their workforce because of it. That means they're going to see less profits, and with less profits means that earnings reports are going to be very bad for the stock market. Earnings reports basically show investors how a company is doing quarter after quarter. If companies continue to do well on their earnings reports, then you know that they're making more money and selling more things every single quarter. However, if they start to put out bad earnings reports and bad guidance, basically saying, yeah, we're not gonna make any money this year, then investors don't wanna invest in a company that's not making any money. That's exactly the reason why they're pulling their money from tech stocks. Investors want to invest in a stock that is going to appreciate in value. That's how you make money from the stock market. But if a company isn't doing well, then the potential for it going into bankruptcy is much higher. And that is the potential that we're going to see in 2022. Inflation going way up and the Federal Reserve actually restricting spending and demand even more by raising interest rates. Americans may not spend that much money in 2022 in order to solve our inflation problem. Sure, inflation will get down to that 1 to 3% mark, but it will also mean that the stock market potentially tanks because companies aren't making those record-setting gains anymore. Instead, they're losing money and they're having to lose a lot of people in the process. They're cutting their workforce, which means unemployment is going up too, which could be bad for our economy. And all of that is kind of a spiraling effect because inflation and the price of everything is getting way too high for most Americans to afford it right now. So what are we going to see with the stock market in 2022? The stock market is heading towards a correction territory, which means most of your major indexes are going to drop between 10 and 15%. It's important to note here that corrections and crashes, they happen on the New York Stock Exchange and in any market for that matter. You're going to have periods of booms and busts, depending on what's going on with the economy and the health of our nation in general. Remember, these are individual people who are trading these stocks. For the most part, it's not computer systems, which means we're going to have emotional reactions to everything that's happening in our society. And with that, you're going to have an emotional stock market that gets really excited about tech stocks and also really scared when they stop making money. But when we see a boom and a bust, we basically see two different competing ideas. When you have a boom, there is a ton of essentially crap that enters the stock market. Bad companies, bad investments, because the stock market knows there is so much money to go around right now that people will invest in anything. And it's a safe investment because the stock market is going up. Eventually, those crap investments go away because they crash. They're not sustainable and people know that, and they aren't going to stick around. Those companies and those businesses are going to disappear, and those assets aren't going to be assets anymore. When they disappear though, all that's going to be left is your stable investments, your companies and assets that can last the test of time because they have sustainable properties. Why do you think Coca-Cola has been around for so long? It's a sustainable, profitable company. Even though it's had its own booms and busts, it's going to be around for the long haul, and it's considered a blue chip stock along with companies like Amazon. That's kind of the period that we're going through right now. These are growing pains for the stock market. Yes, the dot-com bubble of 2001 basically crashed the stock market, but dot-com companies didn't go away. I mean, obviously we still have those companies today. You don't think about it, but pretty much every website you go to is .com. So it survived. The dot-com bubble just erased all of of the bad companies that investors wanted to put their money behind. And the same thing is happening right now. All of these tech companies, they're not all going to survive. Investors are just pulling their money out of all of them though right now. And eventually the ones that are good will remain, so that problem will solve itself. And if we see a more leveling out from the Federal Reserve on their monetary policies, then you won't see a complete crash in the stock market for long. It really just depends on how much more prices go up in 2022, because wages have started to go up too. And if they start to increase at a solid level, then Americans can start buying more things. But this all needs to be in equilibrium. We can't have Americans buying too much, and we can't have them buying too little. If all of that kind of proceeds at an equilibrium, then we could see the stock market and our United States economy in general start to level out in 2022 and get back to normal levels like we saw in 2019. But all of that is a big if. I don't know what's going to happen with the stock market because it's complex and there are a ton of different moving parts. And anybody that tells you they know exactly what's going to happen is either lying to you or trying to sell you something. But now I want to hear from you on this issue. What do you think is going to happen with the stock market in 2022? Do you think that this correction/crash is going to continue for basically the rest of the year? Or do you think the stock market is eventually going to level out and we're going to see some new record gains in 2022? As always, leave a comment below before you go. That is it for me, everyone, and I hope you liked this video, and if you did, be sure to hit that subscribe button below. Be kind out there, and I'll see you all in the next one.